Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
Well, hey everybody, Nate Miller here, host of Retirement Rescue Radio. And we've got a special episode here, and it's called Phantom Gains. And the reason we're talking about phantom gains is because this has actually shown up a few times now here recently. We're just now getting done with tax season. Matter of fact, today is a few special days. Today is April 18th, which this year, that is tax day. It's not normally tax day, but it is tax day this year. And it also happens to be my daughter's birthday. She is 5 years old today, and Harper was actually scheduled to be born on April 15th, the year that she was born. But that was also a year where April 18th was official tax day because of the way that the days fell. And so she was not born on April 15th, which is normally tax day. She was born on April 18th, which was that year's tax year, and it's this year's tax year, or tax day, excuse me. And so, yes, it is tax day. It is my daughter Harper's 5th birthday. And I was informed just earlier this morning, it's also National Financial Advisor Day, which you would think that a day that could possibly be tax day would be more appropriately titled CPA Day, right? It's National CPA Day, but it's National Financial Advisor Day. I did not know that. Nobody got me anything. So yeah, it's just another day. They just make up these days. I think birthdays were just made up by Hallmark to sell cards, right? And I can say that because, well, and I've got a lot of clients that worked for Hallmark, and my in-laws worked for Hallmark too. So it's like a Hallmark all around me. So yes, there's that. And so we'll just go ahead and get into what are phantom gains in the first place. I just mentioned that. It's like we're talking about ghosts here, ghost busting. I don't know. We're going to ghost bust the phantom capital gain. So first off, let's define what a phantom capital gain is, because some of y'all may have never heard that before. According to Investopedia, which we'll have a link in the show notes here, a phantom gain is a situation in which an investor owes capital gains taxes, even though the investor's overall investment portfolio may have declined in value. Now, it doesn't mean it has to have declined in value, but it may have declined in value. So what does that mean? That means if you've got mutual funds or ETFs or whatever funds inside of your portfolio that are not in an IRA or not in a Roth, they are in what's called after-tax accounts. Some places just call that a brokerage account or an individual account, maybe even a joint account. Or if you have a trust set up with non-qualified money inside that trust at a brokerage firm or a TD Ameritrade or Fidelity or whatever, that money in there also could have phantom capital gains. And so a phantom capital gain occurs when you've got fund managers, whether it's the mutual fund managers or the ETF, the exchange traded fund managers, that make buy or sell decisions in your fund, regardless of whether or not you made a buying decision or selling decision, or whether your advisor made a buying or selling decision. They are making these decisions independent of you or your advisor. And so what that means is if you've got a mutual fund, let's say it's got 100 different stocks inside of it, and one of those stocks happens to be Apple. And let's say that mutual fund bought that Apple stock back in the year 2000. And you happen to buy the mutual fund that contained the Apple stock in 2005. Well, now here it is, it would have been 2021, right? They sold that Apple stock for whatever reason. They decided to sell Apple stock, but you didn't sell it. Your advisor didn't sell it, but the mutual fund managers did. So the gain that was represented by that portion that represented the Apple stock inside that mutual fund is going to show up on your tax return, whether you made that decision or not, and whether or not you even received the proceeds, they are still going to show up on your tax return. And we've had quite a few that have shown up here this last year. And I'm trying to figure out exactly why. And I'm most likely, here's what I'm thinking, because I know that there were several decisions to either sell businesses that happened in 2021 because there was the looming threat that Biden may changed the tax code to tax capital gains like ordinary income. Right now, capital gains are taxed at either zero, long-term capital gains, by the way, meaning you hold them for at least a year. So if you have long-term capital gains, he was wanting to take those and tax them like ordinary income. Right now, you either pay 0, 15%, or 20%. 20% is the highest, even though ordinary income, the highest tax bracket currently is at 37%. So he was wanting to take that from the maximum of 20% to a maximum of 37%. So that's almost double what he was wanting to do. And so a lot of companies made the choice, well, if that's going to happen, we're going to sell this year before that law comes to pass. And that way we can realize some of those capital gains at a lower tax rate rather than the possible 37% tax rate. So there could have been that going on. And so we've seen a few of our clients that have those types of accounts that had funds in there before they even came to see us that had some of those occurrences happen. And so they had phantom gains showing up. Now, why is that problematic? Well, because we don't make those decisions, right? We didn't make those decisions. We didn't talk to the mutual fund company and have a conversation about, are you going to make those decisions? Usually these decisions come without us knowing that they're going to happen. And then we find out when we get to 1099. And so then now it's time to like, hey, well, we're going to do some Roth conversions based on this amount of money, and we made this, or we were doing withholding from the checks. If you're getting a retirement check from your IRA or something, you got to withhold taxes from it. We withheld based on you making this amount of money, and you made an increased amount of money. And so that's why it can be problematic to have all of these phantom gains showing up on your tax return, even though you may not have physically received the proceeds. And so that's one of the reasons that it makes it difficult for tax planning. What we like to do is we like to figure out ways to help somebody not have that incident happen as much as possible when it comes to those non-qualified accounts. So as much as possible, we're going to be doing tax loss harvesting. So at the end of the year, we may try to figure out, all right, what do we need to rebalance? What has gains here and losses here? And let's try to work this out to where maybe we can take a bit of loss in a year and have that show up on your tax return instead of a gain. We can do it that way. And that could help move some of your positions out of some of those funds, which are making those decisions without us, and maybe move those into more individual positions. Because our feeling on mutual funds as part of our process is this: if you don't have a whole lot of assets, then yeah, it still makes sense to have mutual funds, because mutual funds were really created as a low cost way of giving you access to a lot of diversification. Because if you think about it, if you've got, let's say you're just starting out investing and you're going to start contributing to your 401k, right? And you're doing, what was it, $200 a month or whatever. So if you're doing $200 a month, are you going to be able to buy even one share of Amazon? No. Amazon right now is trading around $3,000 a share. And so you couldn't even buy one share of Amazon. But enter in mutual funds that might have 100 different companies inside that mutual fund. And therefore, they've got fractional shares of all these different companies, possibly even including Amazon. Now you have Amazon exposure, and you didn't have to pay $3,000 per share to do it. You were able to do that with your $200 a month that you were contributing to your 401k. So it was a way to give you a lot of diversification without having to use a lot of money to do it. So our opinion is, once you have a decent amount of assets, you no longer need that extra layer of management inside your portfolio, because now you can basically, I'm going to use air quotes here, replicate the mutual fund effect of having lots of different positions without actually having a mutual fund. You can have lots of individual positions, and a mutual fund that might have, say, a 0.75% expense ratio. That means that's the management fee you're paying to the mutual fund company. That's not what you're paying to your advisor. That is in addition to whatever you're paying for your advisor. And so without having those, if you just have an individual position, once again, let's go back to Amazon at $3,000 per share. Guess what the expense ratio for one share of Amazon stock is? Absolutely zero. Guess what the expense ratio for Apple is? Absolutely zero. Microsoft, zero. Netflix, zero. You name it, all the different stocks that are out there. If you just have the individual stock, the expense ratio is zero. And so you're not paying that extra layer of management fees to the mutual fund manager, in addition to whatever you're paying your advisor. And you're also not subject to some of those phantom capital gains that could be showing up because you've got somebody else making a decision that you and your advisor aren't even aware of. And so that's why, as part of our process, we like to, as much as we can, reposition some of those funds into portfolios that have a lot more individual positions so that we don't have to worry nearly as much about that. Now, like I said, sometimes it doesn't make tax sense to do that, right? Because obviously, if we sell some funds at a gain with our, like, actually making that decision, we make the decision to actually sell some funds. Well, that's going to be a tax consequence. There's going to be some possible capital gains that you might have to pay. And so we normally don't like to do that unless it makes tax sense. And so there are some things that can help out with that. So one of those examples was, like I mentioned, was tax loss harvesting. We could do some of that maybe to be able to reposition some of those funds. But depending on somebody's situation, it's been a bull market for a very long time. So a lot of those positions might have a lot of gain in there. So that might not be as effective as what it could be. Maybe it's effective, a little bit more effective now because we are in a little bit of a down market. But prior to being down year to date, the market did really, really well the previous year. So there still might not actually be a lot of loss in somebody's portfolio. And so that's one of the ways. And then also there could be some gifts you could do to charity. If somebody is so charitably inclined, you could actually gift stock to charities, whether that's directly or through a donor advised fund. So if you have highly appreciated assets and instead of selling those and realizing some capital gains, you would like to gift some of those highly appreciated stocks to a donor advised fund. Now you're not going to get the capital gains tax assessed to you, and you're going to get a charitable deduction for gifting that money over to the donor advised fund. Now you got to be aware of the specific limitations, like what is the limit that you can contribute non-cash items to a donor advised fund. You still got to stay within those limits, but that could be one of the ways that you end up getting a tax deduction, and then maybe you can reposition some other capital gains in order to maybe kind of wash out the money that you saved by contributing to charity, and then the amount that you actually realize from repositioning. So that could be one of the strategies to be able to make sure that there's not a negative tax event for someone. But once again, that's a lot easier to do if you know what the tax ramifications are going to be and you know who's making decisions and when they're making the decisions. That's why we like to get as much out of those funds that have those additional layers of fees and those additional managers making decisions. We like to get as much out of there as possible. And so just wanted to do that real quick because, like I said, we've ran into that a few times now this year with some of our clients that have sizable non-qualified accounts saying, hey, we had a little bit more gain that showed up on our account, which I guess one is good, like it's good, but we had a little bit more gain show up on our tax return. What was the reason for that? Well, one, it was a good year, so that could have been the big one. But normally, we're not seeing that much happen. That we're not seeing that much though capital gains hit somebody's tax return as what we saw in a few cases this year. And so that's why one of the reasons I believe is because of there was that threat of Biden changing some of the tax laws. Now it ended up not happening, and now he's kind of, I want to say, backed up and punted a little bit to where he still does want to try to tax the I'm going to use air quotes again here, rich, those make with over $100 million in accounts. He wants to tax the unrealized capital gains. And so if you have more than that, then yeah, you're going to, and if that law passes, which once again, I would be very skeptical that is actually going to pass. It has not been met with, the support that is needed in order to pass it. But let's hope and pray that it does not, because what I've said before is once the law gets passed to implement a new tax, now that was the hard part. The easy part is adjusting it. So defining who is, quote, rich can now easily be moved. That dial can be changed. Right now, it may be 100 million. Then it's, 50 million. Now 10 million, 5 million, 1 million, So be careful about trying to enact a tax that only affects, quote, the rich, when you are not the one that gets to define who the rich are. So yes, be very careful about that. So that is it, guys. Hopefully that answered some of your questions about why are these, taxes showing up on my tax return, even though I didn't sell anything. My advisor said he didn't sell anything. It's the mutual fund managers, or even the ETFs are a little bit more passive than mutual funds, but there's still some movement that could happen in and around those as well that could have some of that happen. So guys, that is it for today. And join us again next week. Again, if you have any questions about this, if you want to find out, all right, do I have some of these funds? Could I maybe be put in a better position to where I don't have all these tax consequences happening? So I don't have all these decisions being made regardless of me and my advisor. And so you can do a little bit better tax planning. If you want to find out, just go ahead and give us a call. Our phone number is going to be in the link here. Get about 15 minutes on the phone with us, and we'll be able to answer some of those questions, or at least, go down the process of being able to help you determine whether or not that is something you could be able to take advantage of. So, guys, take care.